So a central bank holds treasuries in large part because they can liquidate them in any kind of business hours. They can just say, we want to sell the treasury and buy back our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to sell, $10 billion worth of gold right now. It's hard to do logistically. And so they do hold it for a portion of their savings, the part they don't really plan to touch anytime soon, whereas they hold other assets that are faster. And for individuals, they start monetizing things like the S&P 500 or oceanfront real estate or lakefront real estate or fine art, right? There's these other monetary things that kind of compete with gold, even if they're not really money in the traditional sense. They're things that they become our primary store of value. They're more efficient. They are powerful. But a lot of people, especially in developed markets, forget that in developing markets, that's not always available. A middle-class person in Egypt can't easily buy the S&P 500, for example, and their local stock market does not have the same long-term store of value properties. And so in those markets, they gravitate toward physical dollars, ironically, or they gravitate toward physical gold. And these are still kind of stores of value in those societies.
Did you know that the supply of gold has only increased by 1 to 2% per year over the past century? Meanwhile, central banks are relying on treasuries, not gold, because cash is easier to liquidate quickly. But Lyn Alden is raising a red flag. This reliance on fiat currencies, built for speed but weaker in value, could be leading us into dangerous territory. For thousands of years, societies have moved towards stronger commodities like gold, but now we're reversing course. What does this mean for your financial security? Could the dollars in your bank account lose value faster than you expect? And is gold still a safe haven, or are we facing new risks with both cash and precious metals?
So in any society, things tend to gravitate toward a common unit of account, which is the most saleable good. Basically, the good that if you were to bring to a market, the highest likelihood that you could sell it for whatever you want. And because otherwise you have a lot of friction in trade. And so generally speaking, some commodities emerge as that which is more liquid, more accepted, and the thing you probably want to store your excess savings in. So most commodities don't really have a monetary premium. They trade based on their utility value, based on their supply and demand, and people don't really store a lot of excess savings in them. They don't just store up barrels of oil, for example. It doesn't have the right properties to do that at scale. And certain commodities start to, in a given technological era, have that feature. So in really early societies, shell jewelry was kind of the thing that, it's the most labor to make it. It's not easy to rapidly increase the supply of, and we can kind of put our excess savings into them. But then over time, basically, anytime you put monetary premium into a commodity, there's a big invitation to dilute it. It's basically saying, look, this is so valuable, we don't know how to make more of it. So if someone does figure out how to make more of it quickly, they get a lot of money. And so over time, as technology improved, we went into the Industrial Revolution and all these other things. We got better at making most types of commodities. We can make all the shell jewelry we want. We can get furs. We can, grow as much tobacco as we want. All these things that were once used as money, it becomes very easy to dilute them. And so people have to always kind of shift toward what is the hardest money to rapidly increase the supply of. And so over thousands of years, gold and silver became the primary answers. That even when, even in our modern technology, we still can't radically increase the supply of gold over any short time period. Only at times where we literally, when industrialized societies found new continents, that's the only kind of brief time period where you could kind of temporarily inflate their supply at above average pace. Because gold and silver have kind of like an inbuilt difficulty adjustment, which is that our technology gets better at finding them over time, but we've also mined a lot of the easiest deposits. So the deposits are getting harder, our technology is getting better, but we're not really increasing the supply too quickly. And if you look at gold over the past century, it's ranged between, and this is like World Gold Council data and US Geological Survey data. There's a couple different data sources you can look at, but gold supply is estimated to increase by 1 to 2% per year on average. And it's been a fairly tight band. You have to go back to the gold rush to find when we kind of meaningfully broke above that. And that was in large part because, again, an industrialized culture was coming to a continent that had not been industrialized yet, so they had a lot of low-hanging fruit to pick, kind of in terms of gold mining for at least a period of time.
And so, essentially, through the method of repetition, civilizations came to realize that gold and silver are the finest ones. And the primary reason why silver maintained its worth is because gold's main restriction was divisibility. Even a tiny gold coin was valued higher than most acquisitions. So silver was sort of the more everyday use metal. And so this only became contested in the telecommunication age because, before telecommunications, speed didn't matter. All goods kind of move at the same pace. Things like coinage could help accelerate the act of measuring and verifying a particular commodity, but aside from things like that, there wasn't really a major speed distinction. But in the telecommunication period, we began to transmit, and that began in the mid-1800s with the placement of the long-distance telegraph wires. We started to conduct trade over great spans very rapidly. And so we started abstracting and paperizing everything, and we started sort of taking liftoff away from gold. And so it's kind of the first instance we shifted from a sturdier commodity to a weaker commodity, sort of the dollar, like this ledger framework, that's actually less solid. We spent millennia always gaining more and more sound, from shells to tobacco to silver gold. And we sort of began reversing because speed was a fresh factor that mattered. So yeah, it's not a coincidence that humans chose gold for so long. It's because it's the commodity with the highest stock-to-flow proportion. How much exists compared to how much can be created in a year. And it's clear, it's got very excellent qualities for how much value density you can keep in it, how long it lasts when preserved. Essentially, it's not a coincidence that all those traits align to be good currency, and therefore it's used as good currency. Yeah, I think that's sort of the stage we're in. I think we're in the initial phases of discovering solutions. And so, the way I phrase it in the book is that rapid exchanges are a simpler issue to resolve than rapid clearings, right? So if you have Morse code and telegraph, you can do quick exchanges. Two people can speak across the Atlantic Ocean and consent on a transaction, and then the clearing is the challenging and sluggish part, sending and verifying gold. Even in the present age, when Germany reclaimed its gold, they anticipated it to take like 7 years, and they were pleased that it only took 4 years, which is sort of a humorous figure. And it cost millions and millions of dollars value of transport, protection, inspection, and all these elements. So quick clearings have been a difficulty. One of the subjects I discuss in the book is that Bitcoin's fascinating because it's sort of the first time where we devised quick clearing, which is to state that as long as the network remains fairly distributed, I can transmit you value, and within 10, 20, 30 minutes your Bitcoin is validated on-chain, and I have no method to retract that. It's sort of final clearing, unless the bulk of miners choose to begin undoing exchanges and things like that. And so, that's sort of the first real chance for identifying that resolution. But then, of course, it has to progress through this very lengthy method of being examined, right? So then people create thousands of other digital currencies, and they say, well, can these perform it superior? Can someone discover a way to exploit it? Or how can it be altered over time to be more effective? And all these things sort of occur, and it's still a very minor market. So it's only, a trillion plus market value in, global fiat money, something like 100 trillion. And so it's still this beginning stage to see if that's truly going to be the answer. I think it's a very strong solution, but it clearly requires time for the market to examine it and embrace it. And so, as long as we're still in this realm where Bitcoin is little and fiat is huge, we're still sort of in this strange limbo of quick exchanges and sluggish clearings. And one of the aspects you notice is that both on a personal level and on a national level, they regard speed to be a factor. So a central bank possesses treasuries in large measure because they can convert them during any kind of work hours. They can simply say, we want to trade the treasury and repurchase our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to trade, $10 billion worth of gold right now. It's tougher to accomplish logistically, and so they do retain it for a segment of their reserves, the part they don't really intend to access anytime soon. whereas they hold other holdings that are quicker. And for persons, they begin monetizing things like the S&P 500 or seaside real estate or lakeside real estate or fine artwork, right? These other monetary items that sort of rival gold. Even if they're not truly currency in the conventional sense, they become our principal preservation of worth. They're more efficient, they are potent. But many people, especially in advanced markets, overlook that in emerging markets, that's not always attainable. You know, a middle-income person in Egypt can't simply purchase the S&P 500, for instance, and their local stock exchange does not have the same long-term preservation of worth qualities. And so, in those markets, they shift toward tangible dollars, ironically, or they shift toward tangible gold. And these are still sort of preservations of worth in those cultures. Thanks for viewing today's video. To summarize, we examined some key observations from Lyn Alden on the weakness of fiat currencies and the significance of solid assets like gold. We discovered how the provision of gold has been steadily scarce, while cash and treasuries provide swiftness but come with the risk of diminishing worth over time. As civilizations keep moving away from sturdier commodities, it's vital to reflect on where we preserve our riches. If you found this discussion worthwhile, ensure to subscribe, like, and circulate the video. And don't overlook to share your opinions in the remarks below.
Don't forget to like our video and subscribe for our channel.